Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 14th of July 2020, and on Sunday we produce an exclusive video on silver entitled Silver Institute Forecasts $21 Silver in 2020, and on Saturday our gold and silver weekly update for the weekend in the 10th of July. Now these two videos highlighted that we could expect to see both higher gold and silver prices, and especially silver, as it does a degree of correction in relation to the gold to silver ratio. This it has done. Yesterday we saw silver prices rise to a most impressive $19.41. Please note, within our $19.50 limit we stated on Saturday, and has since fallen back to its current level of $18.96 as at 1300 GMT plus 1. Gold rose too, to $1,818, but has, like silver, fallen back and currently stands at $1,797 an ounce. It's interesting to note that at their peak, the gold to silver ratio was 93.6, but currently rests at 94.7. Now, regular listeners to our channel will note that we predicted the gold to silver ratio would eventually fall from 100 to 1 to early 90s to 1. And will probably for some time rest between 90 to 1 to 95 to 1. Let's wait and see if this plays out as we forecast. It's interesting to note too the retrenchment of precious metal prices today, especially as the US dollar has weakened further and the dollar index currently standing at 96.4. That said, this may present itself as an opportunity to buy, especially as financial data being announced around the world is more grave and worse than even many pessimists predicted. Let's take a brief look at two articles published by Bloomberg today. They're very short. The first on the UK economy and the second on Singapore. We shall play them to you now. Bloomberg article dated July 14th, 2020. Headline: UK faces biggest budget deficit in peacetime history. Britain could see its budget deficit soar to a peacetime record this year as the coronavirus lockdown hammers the economy, according to the country's fiscal watchdog. Borrowing, which was forecast to be £55 billion, the equivalent to $69 billion, could now hit £322 billion. The Office for Budget Responsibility said Tuesday. That's the equivalent of over 16% of GDP, the highest for any year since World War II. Debts remain above 100% of GDP for the next 5 years. The projections are based on a central scenario, meaning the deficit and debt could be higher if the economy performs worse than expected. Crucially, the estimates don't include the impact of measures announced by Chancellor of the Exchequer Rishi Sunak last week, which came too late to be included. The OBR puts the stimulus and extra spending on public services at around £50 billion, which would take the deficit to £372 billion, Chairman Robert Choate said in an online presentation. The OBR sees the economy contracting by more than 10%, in all three of the scenarios it published, the most in 3 centuries. In the worst case, output falls by over 14%. Unemployment is expected to peak at 11.9% at the end of the year, and under the worst scenario could reach as high as 13.2% early in 2021, the OBR said. The watchdog no longer thinks the economy will make a rapid recovery next year, as it forecast in April. Instead, its central projections sees the economy growing 8.7% next year, following a 12.4% contraction in 2020, implying a degree of permanent scarring from the lockdown. Output is expected to regain its pre-virus peak by the end of 2022, with GDP 3% lower in the first quarter of 2025 than previously forecast. The downside scenario sees the economy remaining below peak until the third quarter of 2024. Now, in a separate document, the OBR raised its estimate of the cost of direct government support for the economy to £192 billion, in line with Treasury figures published last week. Choate said governments would find it hard to finance their debts if debt was allowed to continue on its explosive path. Under the central scenario of fiscal tightening equal to 2.9% of GDP, or over £60 billion today, would be needed each and every decade to bring back debt to a more sustainable 75% of GDP by 2070, Choate said. Bloomberg article dated July 14th. Headline: Singapore slumps into recession with record 41.2% GDP plunge. Singapore's economy plunged into recession last quarter as an extended lockdown shuttered businesses and decimated retail spending, a sign of the pain the pandemic is wreaking across export-reliant Asian nations. Gross domestic product declined an annualized 41.2% from the previous 3 months, the Ministry of Trade and Industry said in a statement Tuesday, the biggest quarterly contraction on record and worse than the Bloomberg survey median of a 35.9% drop. Compared with a year earlier, GDP fell 12.6% in the second quarter versus a survey median of minus 10.5%. The deep slump shows the blow Singapore's economy is taking from all sides amid the pandemic. A plunge in global trade has hit the export-reliant manufacturing industry, while retailers saw a record decline in sales after partial lockdown measures were imposed last quarter. The government, which has projected a full-year economic contraction of 4% to 7%, didn't provide a new Treasury forecast today. Singapore is one of the first countries to report quarterly GDP data, and the figures show it's taking a bigger hit than many others in Asia. Japan's GDP is seen declining more than 20% on an annualized basis in the second quarter from the previous 3 months, while data this week probably will show China's economy return to growth. The dismal outlook in Singapore is pressurizing the ruling People's Action Party, which had its weakest performance ever in last week's election. The government has already pledged about 93 billion Singaporean dollars, or 67 billion US dollars, in stimulus to shore up troubled businesses and households and prevent a surge in retrenchments. The road to recovery in the months ahead will be challenging, Trade and Industry Minister Chan Chun Sing said in a Facebook post Tuesday. We expect the recovery to be a slow and uneven journey as external demand continues to be weak and countries battle the second and third waves of outbreaks by reinstating localized lockdowns or stricter safe distancing measures. Singapore's advanced GDP estimates are computed largely from data in the first 2 months of the quarter and are often revised once the full quarter's data are available. The second quarter may mark the low point for the economy, although the recovery is likely to be slow and gradual. Most businesses began resuming operations from late June, but border controls and social distancing rules, which limit mobility, remain. This is the bottom, unless Singapore is forced to regress to the harsher iteration of circuit breaker measures, said Vishnu Varathan, head of economics and strategy at Mitsuo Bank Limited in Singapore. The case for more stimulus is neither ruled out nor a mechanical reaction to this backward-looking data point. The 4 fiscal packages need time to permeate and cascade. Singapore's dollar fell 0.2% against the US dollar. So, as we can see, the COVID-19 pandemic is affecting markets and to some extent is currently the major influencer of them. With over 13.2 million cases worldwide and 3.5 million of them being in the United States, and a number of other countries beginning to show a further rise in infections, it's not surprising that this is the major theme of the day. Now, earlier today, the United States announced that the Consumer Price Index for June has come in at 0.5%. That's a positive 0.5%, compared with May's minus 0.1%. And core CPI for June is reported at a positive 0.2%, compared with May's minus 0.1%. And later today, Fed Governor Lael Brainard will be speaking, perhaps giving some indication of what the Fed is currently thinking. So meantime, let's see what transpires. But currently, equity markets around the world are in marginally negative territory. So we've had precious metal prices generally dip from their recent peaks, not significantly, but dipped nevertheless. And we're seeing equity markets also falling, together with the dollar falling, which is an interesting concoction or mixture of the three. What do you think? Do share your thoughts. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they're published. Not forgetting, we have updated our Richard and Greg channel every few days, and we've produced 2 videos on that in the last 3 days. So please pop over to there and hopefully subscribe there too. We hope you have found this video interesting and informative. And if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.